All right, let's go ahead and get started. Today we're going to be covering small business retirement plans. So we're going to be focusing mainly on SEP Simple and the ever-loved solo 401k plan here at Advanta. Again, if you do have any questions, make sure you type those into the chat box. We're going to go over a lot of this stuff. It is very detail oriented, and if you do have any questions, feel free to ask. Again, I am always happy to try to be as much of a resource as possible when it comes to this kind of stuff. So again, any questions, go ahead and ask them. With that said, let's go ahead and get started. My name is Alex Perny. I've been doing this since about 2012. I kind of started cutting my teeth in the self-directed IRA space with doing investments for clients. During my tenure of doing investments, I was involved in about 1,200 individual different deals for clients. So I have a lot of experience on the deal side of things as a lot of experience on that front. So with that said, if you do have any questions on any type of thing, just let me know. With that said, I'm going to go ahead and advance. Advanta IRA and our employees do not provide investment advice, nor do we endorse or promote any investment products. All informational and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So a few key takeaway points from here today. If you want to basically fund one of these types of plans, you can do it from contributions, but you can also do it from old employer plans as well. So any type of old employer plan or existing IRA can typically be used in this form or fashion. A few things about us. Advanta IRA, we have well over 20 years of industry experience doing this. So we have a lot of, again, track record in administering these types of plans and helping clients out. We also administer over 1.3 billion in assets for our clients to this point. So again, if you have questions on this kind of stuff, make sure you do ask those. We'll go ahead and get a few of the questions answered here before we get into too much of this, just so we can make sure that backlog is completed. Let's see. Jay asked, if a qualified plan is converted to a self-directed 401k, are there still any annual reporting requirements depending on the balance, as in the case for qualified plans? Well, in the case of this question, a qualified plan in the context of what we're talking about is going to be an ERISA qualifying plan. So with that said, yes, there are still the same type of reporting requirements depending on plan value. So if you have over $250,000 of plan assets in a solo 401k specifically, you do have the requirement to do Department of Labor and IRS 5500 easy reporting, which we can certainly do for you, or you can do it yourself as the trustee, depending on how you want to structure the plan. So yes, the same reporting requirements are going to be in place really no matter what type of plan you have. It just depends on kind of who is going to be doing it to that point. Let's see, another question, does the self-directed 401k allow for participant loans? Yes, when you do the adoption agreement, you elect to allow that to happen. Absolutely. And lastly, the recorded webinar will be posted on YouTube after it's done. So thanks for the questions. Keep them rolling in. So what is an employer-sponsored plan? So a self-directed 401k, SEP IRA, or simple plan assist employers in retaining employees and to help their employees become financially independent with retirement plans. Now, this definitely is in the context of larger companies, exactly why these things are established. But just because you're a sole proprietor or a self-employed individual does not mean that you have to miss out on this. These plans also can distill down into a format that works for you as the self-employed individual. I just spoke with a woman the other day that wasn't even aware that because she was self-employed, she could take advantage of things other than just an IRA. So it's important to understand that you're not necessarily losing out on any of the larger options that are available to people, like Walmart, IBM, large, huge employers that have these large employer plans. The same types of benefits can be set up for you on a personal level for your self-employed business, and you're not having to lose out on just not being an economy of scale. So that's kind of the reason that these things exist, but also just understand that these things do also offer the same exact benefit, in some cases a larger amount of benefit to you as the employer, because you can game it a little bit to maybe be able to get more contributions than you would as a W-2 employee into these plans. So there's a few key components to understand about employer plans. There's basically three parts. You have to have a sponsoring business. So if you're just a W-2 wage earner and you do nothing extraneous from that job, you just kind of punch a clock and you just want to have a higher contribution limit plan, unfortunately, these types of plans will not necessarily work for you. You have to have some type of self-employed income or some type of business activity to attach these plans to. With IRAs, anyone can have an IRA. It doesn't matter, as long as you file a tax return, you can have an IRA. As long as you make earned income, you can contribute to one. But it definitely is a little bit more complex when it comes to employer-sponsored plans or qualified plans in this matter, because you do have to attach it to some type of business activity. Now, what type of business activity is that? Well, it doesn't necessarily have to be something as formalized as, let's say, a C Corp, which a lot of people, especially self-employed individuals, will opt away from because paying corporate taxes instead of flowing everything to your personal income tax statement is typically a much worse shake. So you can be an S Corp, you can be a sole proprietor, you can be an LLC tax as a partnership, an LLC tax as a pass-through. All these different kind of things work, but the important key point to understand is you have to have a sponsoring business. The other part, now this is a little bit more of the context of what a larger business is, but for you, you have to understand that the relationship to the plan is that you are the employee of the business. Even if you are the sole owner operator, you are still technically, in the context of understanding contributions and everything else, a participant of the plan or an employee of the business activity. So with that said, you also have to keep in mind that certain plans don't scale as easily as other plans do. Namely, the big culprit in this is the solo 401k. Once you have rank and file employees, someone other than the equitable owner of the business or the spouse of the business owner, you have to have a significantly different type of plan in place in order for that to work out. You can still have a 401k, but you just can't take advantage of the exemptions from the solo 401k for reporting and plan compliance aspects. Now, what is an employee? That actually changed a few years ago. It used to be any one individual that worked more than 1,000 hours per year in any given year. It changed with the passing of the Secure Act to be defined as any person that works over 500 hours per year over 3 years for you can be considered an employee. So it's important to understand that if you are a small business owner and it's just an owner-operated business, but you have someone that maybe comes in and does bookkeeping for you or housekeeping, something like that, that is doing some type of service to your business, then you need to make sure you understand what qualifies them as an employee or an excludable individual from that plan. And we'll get more into that here in a minute. Contributions are the last thing to understand. And we're going to get really far into this, but contributions to these plans, some of them you're looking at two different buckets of income when it comes to qualifying the contribution, but some of them you're only looking at one, and sometimes the bucket is going to be the same, just with different kind of names to it. So again, sponsoring business, participants / employees, and contributions are the important things to kind of really gravitate towards when we're going to be looking at this stuff. Let's see, got a few more questions. Since we are in June of 2022, and since 5,500 reporting for 2021 is due in July, when would be the appropriate time to make the switch? Well, with regard to that, in the context of I believe what you're asking, Jay, is you can essentially, if you have a solo 401k externally from Advanta and you wanted to use our services, you can do a plan. You can amend the plan to just have a new plan document and service provider without fundamentally changing the actual plan. So let's say you have ABC LLC 401k plan with someone, let's say like Fidelity. So you could essentially take your plan document with Fidelity, you can amend it and restate it, essentially still keeping the same plan EIN number, still keeping everything else the same, but just utilizing our record keeping services, and therefore the 5,500 reporting would not essentially change at all. You would just be kind of changing the back end of the plan, but fundamentally as just a structure, the plan is not going to change with regard to how it does its reporting. Tax ID numbers, trustees, plan name, all that kind of stuff stays the same for the 5,500 report. So I think that kind of addresses that. And then another question is, if a qualified plan is due for a periodic restatement, should the switch made prior to that or after? Again, that's really kind of personal preference. You're going to have to do the restatement anyway if you're going to be doing a plan amendment. Doing the restatement is something that has to be done, so I wouldn't necessarily base my decision on doing some type of switch based solely on that, because you're going to either have to do it with the new plan document service provider and record keeper, or you're going to have to do it with the old one. In either regard, you're still going to have to do an updated adoption agreement to the new plan document prototype. So, where you do it is kind of just an option for you. I would probably lean towards doing it with the new administrator, just so that way the person that you're engaging has the most accurate records for the plan, and you don't have to go back to an old service provider to try to dig up a plan restatement if ever need be. It's always going to be done with the current and most accurate plan document service provider to that point. So again, great questions. Keep them coming in. Again, sponsoring business, participants and employees, and contributions, the big things to take away from the context of what makes up an employer plan. So 3 different plans, and you need to understand the difference when it comes to these types of plans, because one, you can't maintain all of them for the same business, and you can't maintain them separately from other businesses as well. So it might change your ability to have coverage if you are involved in one plan versus another. So all employer plans are not created equally, and some can greatly affect the way you contribute cash and administer the plan. So these different plans allow for corporate deductions, and some also allow for personal deductions. So depending on where you actually want to claim your deduction is going to really determine a lot of how you want to actually choose the plan for this. And also, some of them do require employee contributions to receive an employer contributions, and others do not. So there's a lot more on the table than kind of just looking at it simply of saying, okay, well, I like the contribution limits of one plan versus another. When making these types of decisions, it's important to understand every single layer of this. It's not just like with an IRA saying, okay, I'd like tax deductible contributions to a traditional, or I'd like Roth contributions to a Roth and make it after tax. So understanding the layers is very important, and it's important to kind of go down the entire rabbit hole, if you will. We have a question: if a qualified, here it is. If someone is an LLC owner and there are no employees in the company, the owner does not withdraw any W-2 salary. If the LLC net income at the end of the year, can it contribute to the SEP? Well, that's going to be kind of dependent on how you actually pay yourself in that context. So to kind of reiterate the question, if there's an LLC that is established and you're not being paid a W-2 salary, are you extracting everything from that LLC as compensation in some other form? Are you taking it as self-employed income? Are you taking it as 1099 income? Because portions of these plans, you have to look at the contributions in the context of where the money was earned as to being able to contribute it. Specifically with a SEP, the contribution is based on the compensation received by the participant of the plan. So if you essentially are a single member LLC and you said you paid yourself zero compensation, you couldn't necessarily do a contribution to that SEP IRA. However, with the solo 401k, if you paid yourself zero compensation, yeah, you might miss out on the ability to do your first compensation deferral of $19,500, but you would be able to do the non-elective quote profit sharing contribution into that plan of 25% of the NOI. Pass-through income on K1. So yes, if you're considering that compensation for your, if that's being considered compensation for your business activity, then yes, you could use that for qualifying the SEP contribution. However, if it's not considered earned income for the purposes of your traditional IRA contribution, which can be compounded into the SEP IRA, the traditional IRA component of the SEP, then you might not be able to fully maximize the contribution to that plan. But again, the option would certainly be there, and the ability to make the contribution would be allowed. So moving money into these plans. So it's important to, again, understand coming into it where you can pull funds from, because I think a lot of the time people are under the impression with a business plan, especially with a self-directed one or one that's being started for a business, you have to just do it with contributions only. That's certainly not true. The only thing you really cannot use to fund one of these is a Roth IRA. So even though the 401k does allow for after-tax Roth contributions, you cannot roll over a Roth IRA into a solo 401k. Solo 401k Roth components can roll out to Roth IRAs, but it's kind of a quirky IRS rule. I don't know why they do that. But any type of pre-tax retirement plan can be used to fund these. So if you have an old 401k with a job you left, you have a traditional IRA, an old SEP, an old simple, governmental 457 plans, thrift savings plans, 403bs, 401as, all of this kind of stuff can be used to funnel into this new business plan. You don't have to start from scratch. So it's important to understand that, and we can help facilitate that as well. However, I would say the lion's share of people that start these plans typically do it for the purposes of tax planning and tax mitigation. So they're typically starting with contributions in any regard to that. Again, another slide, just understanding how the mechanisms of movement for some of these plans work. I'm not going to spend too much time on that. So again, the options that we're going to cover today, the simple IRA, which I feel is a horrible name for an IRA. It is this the simplified the simple IRA is a rather complex and antiquated plan, but it does have its place, especially if you do have employees. It can be a little bit easier to administer. The SEP IRA, or the simplified employer pension, is kind of the successor or spiritual growth of the simple IRA into a significantly more simple plan to administer, but it doesn't necessarily allow for as much flexibility when it comes to having employees. But calculating your contributions to a SEP IRA, infinitely easier than going through the simple stuff, and you also have less restrictions on terminating those types of plans as well. And then lastly, the individual 401k, which is probably, I would say, maybe the most cumbersome to understand on a face value, but definitely offers the most bang for your input on that, as far as what your options are, allowing for Roth contributions, exemptions from certain types of taxes. Just a lot of really cool stuff that goes into the individual 401k plan that is not used or is not allowed with other types of retirement plans. So contribution limits, what everyone probably kind of wants to understand more about. Let's see, before we dig too far into that, question, can I do trustee to trustee transfers of a 401k? Does it make sense to do Roth 401k for an individual over 62 years old? A trustee to trustee transfer, I mean, yeah, sure, you could transfer money between 401ks via a direct rollover. It's not a problem, it's easy enough to do. And then does a Roth 401k make sense for someone who's 62 years old? I can't answer that question for you. I can't give tax or legal advice, but I would say that there's not necessarily an age that I would see anyone not benefit from having Roth money. It really mainly depends on your penchant for front loading and paying more taxes to be able to get the tax benefit of tax exempt growth and distributions in that plan. So depending on really what you're aiming for, if you want to get a lot of tax write-offs and reduce your taxable liability in a given year, then yeah, the Roth's not going to make as much sense for you because you're not getting deductions for contributing that money in, and also potentially in a 401k claiming in additional taxable income if you're trying to convert the non-elective deferral portion of that plan contribution. So it's really hard to say. It just depends on what you're looking to accomplish as to which one makes the most sense. I would never necessarily say it's something predicated on age per se. It's all based on what you're trying to accomplish is where you should probably make that decision on that. So for year 2022, hard to believe it's already 2022. Traditional and Roth IRAs are going to be $6,000 or $7,000 over the age of 50. Actually, I believe it's, I think that's incorrect. I believe it's 6,500. Sorry about that, but everything else looks to be correct. SEP IRAs, you can contribute up to $58,000 or 25% of your compensation to that plan. You also get the additional benefit of your traditional IRA contribution being tacked on top of that. So you get, mid 60s with your SEP IRA contribution calculating in the additional contribution for the traditional IRA portion, so long as that you are paying yourself some type of earned income to qualify that additional traditional IRA contribution to that plan. Simple IRAs, you have $14,000 that you can contribute out of your compensation, and an additional $3,000 if you're over 50, and up to 3% of a non-elective employer match or a 3% elective match to employees. So it gives a little bit of additional options there, but I'm not going to spend too much time on that. The solo 401k, again, this is where I think a lot of people are looking for more information, is you can contribute up to $20,500 of your personal compensation this year to the plan. It was $19,500 last year. So if your compensation, what you're paying yourself, you can contribute tax deductible or after tax. So you can make this either deductible or non-deductible. So Roth be traditional into the plan, not a problem. You also get an additional $6,500 kicker if you're over the age of 50 of additional income you can contribute to the plan. You get to also contribute up to 25% of your either total compensation if it's a straight LLC, if it's a straight pass through, or basically the way that it's really written is that you get a 25% match of your net operating income of your business activity up to a total combining your contributions, your elective deferral and the contributions of $6,100 if you're under 50, and then $67,500 if you're over that. ESAs did not change, and health savings accounts went up a little bit to $3,650 if you are a single coverage plan, or $7,300 if you're a family plan. So that's kind of the contributions in a nutshell. It's relatively easy to kind of just look at it and say, okay, great, but what you need to understand specifically is the 401k right here is the only one that allows for after-tax contributions. The SEP IRA is awesome if you're just looking to have something very simple and something that is going to generate a lot of tax deductions for you. Now, that's good for people who maybe make a lot of money that's earned income or a lot of 1099 income. So think people like realtors really like them. Subcontractors that maybe just get a lot of 1099 income really like those. Not to say that they maybe wouldn't like a solo 401k equally, but those are the people, or I should say, those are the types of professions and people making money that typically see a lot of benefit because they're looking to just basically get as much of a write-off as easy as possible into that plan. However, it's all made pre-tax. Again, with the simple, it's all made pre-tax. The solo 401k is the only one that allows for in-plan after-tax contributions. That's not to say, it's not to say I don't necessarily have people that do this, that make their full SEP or simple contributions and immediately do a Roth conversion. So they make the contribution one day and they convert it the next day. So they basically claim the deduction and then claim the additional income. So it basically offsets everything for that. And just go right from there. But again, the solo 401k is the only one that allows you to do it in plan, which is pretty cool. Okay, question. Solo 401k. Can you clarify 25% employer match of employee salary or net operating income of the company? So it depends on how you're structuring your company for tax purposes. Essentially, the way that it's written for anything other than a C Corp, which I don't really get into because it just adds a little bit of information that people don't necessarily need, is it's 25% of the net operating income of the business. Now, that could be your total compensation if you're passing it through as a S Corp. That number is going to be the same if everything directly passes through to you. If you're doing it something where maybe you bifurcate it a little bit and you're doing it as an LLC partnership and you're not passing everything out on K1, then you might have two different buckets of money to look at when determining which one you're going to base your compensation deferral and your essentially your non-elective corporate match into that plan. Now, I kind of use the word corporate match and non-elective deferral. Think about it as the employer match. If you're looking at this in the context of larger 401ks, an employer says, hey, they're going to contribute X as well to the plan. That's what we're talking about here, just on a much more micro level. So again, to kind of make a long story short, it just depends on how you're actually factoring in your compensation and your cash flows through the business and how you're electing the taxation and the structure as to which bucket you're going to look at. And again, just to kind of further clarify, it's always best to ask your CPA or a tax preparer or tax advisor which buckets you're going to use for these calculations, because ultimately we cannot make those determinations. I can give you the round numbers and tell you, hey, if you have this number, here's what your contributions could be, but I can't tell you with a definitive answer saying, hey, yes, for your situation, looking at this specifically, here's your maximum contributions. It's always best to have a qualified party look at that. Now, with these plans, essentially, specific to what we do, you're not giving up any option. You have the ability to invest in things like real estate, notes and mortgages. You can even do brokerage under these 401k accounts if you are the plan trustee. So you're not really, the only thing you're gaining with using us, really using a service like ours, you're only gaining options. You're not losing anything. Yes, if you're interested in doing some type of brokerage, it's not maybe as easy as just having the account with someone like Fidelity and doing it directly. But almost any of these larger administrators, and we can plug you in with people, specific to our 401k plan at Advanta, TD Ameritrade if you're interested with using a brokerage component, but also having it as a record keeping account, but mainly focusing on alternative assets. We can even structure that kind of stuff for you as well. So the amount of variety that you have with doing plans like this in a self-directed fashion are immense. Now, that really is kind of specific to the solo 401k because you get to act as the plan trustee. With custodial-driven plans like the SEP IRA and the Simple IRA, you really have to use the investment allowances that we have here at Advanta. So we can't hold brokerage accounts for those types of things since we are acting as the custodian. You can really only do it if you are acting as the plan trustee if you want to have that full amount of variety. So again, could be something that influences your decision as to which way you're going to go with this. But again, good to understand the investment options available to you with using a service like ours. Now, it's also good to know what you can't do. None of these plans are going to have any different changes from the rules that govern normal IRAs. So you can't invest in life insurance policies, you can't buy collectibles, antiques, alcohol, stamps, rare firearms, things like that. You also can't deal with disqualified individuals. So meaning you can't buy or sell anything directly to or from or engage in across the table transactions with people like your mother, father, son, daughter, or spouse. However, the one caveat to that is while with IRA plans, especially, and this does include SEP IRAs and simple IRAs, Roths and traditionals, ESAs, HSAs, the penalty for doing so is a disqualification of the plan and a lot of amended tax filings and penalties you have to pay. With a 401k, and I have to disclaim this, I in no way endorse people doing anything other than actually allowable investments, but if you do run afoul of IRS rules with a 401k, the penalty is not a disqualification of the plan, but a 10% penalty of the value of the prohibited transaction per year until it's corrected. So take that for what it's worth. If you are planning on doing something that you feel in some type of a gray area, solo 401ks are going to give you a little bit of a safety net for that. Again, with retirement plans, I can't stress this enough. Doing things that are as easily definable and have the most light shed on them from this viewpoint of the IRS rules is always probably the best way to go with this. Because at the end of the day, this is not something that you're going to be able to take personal tax deductions on if you suffer losses and things like that. You're messing with a phenomenal tax sheltered type of account, and making sure you do everything by the letter of the law is very important. Now, considerations with UBIT and UDFI are something that also need to be addressed here as well, because if you do invest a IRA into an active trader business or you take on debt financing to purchase some type of asset, doesn't matter if it's real estate or what have you, you are going to be, the IRA is going to be subjected to these types of taxes. Now, people a little bit erroneously think that 401ks are exempt from UBIT. The only thing that a 401k is exempted from in this, and it's a very big deal and something important to understand, is that if a 401k goes out and borrows money, so let's say you made your contributions, you have about $50,000 in your 401k plan, but you want to buy a property that's worth $150,000, so you need to finance the other $100,000. IRAs would have to pay taxes on the income associated with the debt to equity ratio on the property. 401ks have to file none of that because they are exempted from the debt finance income portion of the UBIT subsection of the Internal Revenue Code, meaning that a 401k can go out and borrow non-recourse debt to its heart's content and have no additional tax that has to be paid. It's an extremely powerful tool, but it doesn't expand out into if you're going to borrow money for anything other than real estate, or if you're going to have your IRA own an active trader business. So it's important to understand. People think that 401ks are exempt from UBIT. They're only exempted from a small portion of it, but that small portion is a very big deal. Just a little bit of an illustration on whom the disqualified persons are in the context of whom you can and cannot deal with. So how to make the decision. 401ks, solo 401ks, have no special discrimination testing for an owner-only business. However, if you do have a business with employees, so remember, someone that works over 1,000 hours per year in a given year for you, or someone that works over 500 hours per year over 3 years, you're going to have a more compliant 401k plan that is going to have plan testing associated with discrimination and a lot of other things that go into that. This discrimination testing is based mainly on fair treatment of all employees and offerings in that type of context. So you just need to understand that a solo 401k, if you do have someone that qualifies as an employee, is a completely different ballgame. We can certainly help you out with that, but the solo 401k is really designed and streamlined for owner-operated businesses. Now, with that said, if you have a business that has 5 or 10 owner-operators, you can still use a solo 401k plan. I have a group of clients, I believe it's 6 of them, their brothers and their siblings and their parents are all equitable owners of a real estate company, and they have no other rank and file employees, and they use a solo 401k that covers 6 people. So that's kind of cool. Just because it says solo doesn't mean it's just one person or one person and your spouse. It can cover many people, but they all have to be at least some portion of an equitable owner of the business. The second you have a rank and file employee, you have to switch over to having a compliantly tested 401k plan. SEP and simple IRAs scale a little bit better, but don't offer as much flexibility as far as what the 401k does. Simple IRAs can cover up to 100 employees. SEP IRAs can have an unlimited amount of employees. So you can have as many employees as you want with a SEP IRA with really no additional administrative overhead. So what type of employees are excludable from an employer-based plan? Individuals under 21 can automatically be excluded, non-resident aliens, and unionized employees covered by collective bargaining. So if you have these types of employees, they can be excluded. Now, not to say that people should go out and just look for ways to exclude employees, but it's important to understand, at least from an offering standpoint, who you do and don't want to offer this plan to, and trying to mitigate your costs and offer it fairly to everyone involved. But those are the people that can be excluded from employer-based plans. What kind of people must be included? Again, the 1,000 hours per year or 500 hours over 3 consecutive. SEP IRAs, you have to include those people who have worked at least 3 out of the last 5 years on the same 500-hour per year testing period. And simple IRAs, those that have received at least $5,000 in compensation during either of the last 2 years. Now, the simple IRA inclusion does also bring up a good point. Simple IRAs are good for people that have maybe a lot of part-time employees or transient employees. Example, maybe someone that owns a surf shop out on the beach that maybe just has a couple high schoolers that work during the summer. They don't get paid a whole lot. They just want to be on the beach and go surfing. If you want to have a retirement plan, a simple IRA can be a good way to have a low-cost option if you do have to have employees. So understanding who can and can't be excluded also is a good way to understand what might be the most cost-effective and efficient plan for you as well. So what are some advantages of SEP and simple IRAs? They're less expensive and easier to administer. That is just a flatline fact. They are just going to be much simpler from you as the business owner to administer one of those. Contributions are made directly to IRAs, and they have no fiduciary liability on behalf of the business or the business owner. Now, with a 401k, you definitely do get into that because you're acting as a trustee. The individual employee can choose the IRA custodian. So if you want to self-direct your SEP IRA, and let's say your employee doesn't want to self-direct, they could open up one at Charles Schwab or Fidelity, and you just make the contributions there, so long as you're doing it in the same rate as, treating everyone equally with the same rate of contribution level. They can have it wherever they want to. So it gives you additional flexibility, especially if you have an employee, as to where they administer, because whether I like it or not everyone's a good fit for self-direction. Someone that just wants the ease of having a money market account or buying some ETFs is going to be better suited for a company that offers that. And you, as the plan, the sponsoring business, can certainly offer that type of flexibility with using some type of IRA-based plan. Now, they're portable from one custodian to another. So if you decide to change or do something different, it's very easy to change that kind of stuff. And employer contribution, only those employees that, again, with more than 2 years of service to a simple IRA or more than 3 years of service, if they're qualifying with a SEP IRA. Let's see, question, can a Roth solo 401k invest in cryptocurrency? Yes. Any type of our accounts can invest in cryptocurrency if you are interested in doing so. Now, some 401k plan advantages. You have higher funding limits. benefits. So you're going to be able to get the most out of this with a solo 401k, and at least to my summation, a little bit easier than the other plans. Not to say that it's easier to administer, but easier from the standpoint of how much money you have to earn or revenues that have to be generated. You can get to that number, I feel, a little bit easier than with a SEP IRA. Because with a SEP IRA, remember, it's just based on compensation. So 25% up to that $58,000, that's a lot of money you're going to have to be making in order to maximize that contribution. Whereas with a solo 401k, you can make about 2/3 of what you have to make with a SEP IRA in order to maximize the contribution to that plan. So the flexibility aspect and the higher funding limits don't really kind of paint the whole picture. The solo 401k adds for a little bit of ease on getting to that total number, but it is a more complicated and cumbersome plan to administer. So again, with everything when it comes to tax planning, there's a trade-off. There's not one magic bullet that's going to cut through everything and make this as easy as possible for you. You're going to have to make some decisions, and that's one of those kind of things that you need to weigh when choosing the type of plan. Now, you have different opportunities for rollovers. You have access to tax-free loans. So like someone asked in the beginning, you can take a participant loan from a 401k up to half of your vested balance or $50,000, whichever is less, and that's non-taxable. You can have that lent to you, use it for whatever you like. You have 5 years to repay it. Interest has to be pegged a point above or below the prime rate. And if you fail to repay it, it just becomes taxable income to you. But again, you do have to make at least a quarterly payment. It has to be repaid back in 5 years, and the like. You do get to escape UDFI for leveraged real estate investments. They can be relatively cost effective if it is a solo 401k and it's the only one that offers a Roth option directly in the plan. All right, we have another question. Let's see. If I'm a S Corp shareholder with a salary of 100K and I'm under 50, I can contribute up to $40,500 to a solo 401k. In addition, I can contribute 6K to a Roth IRA. Or did I max out? Well, you can still make your IRA contributions, but you would, I mean, it just depends on how you're chopping that up. And I think that answers the question. It's fairly straightforward. If you want to, if I'm not answering that specifically enough, let me know. But yeah, I mean, if you participate in a solo 401k, I mean, for example, I participate in a solo 401k here. I participate in the 401k here at Advanta, and I still make Roth IRA contributions personally. Not a problem. It doesn't affect your ability to make those other types of contributions. The only time that your contributions are going to be limiting in any real form or fashion is maybe your deductibility. If you are participating in a 401k and your ability to write off the taxes on a traditional IRA contribution, those are going to be limited if you participate in both those types of plans. And then also, if you're covered by multiple 401k plans, you're also going to have the aspect of only being able to contribute up to your $20,500 of compensation deferral to the plan per year across all plans. So the total of that can't be more than $20,500, but you can participate in the non-elective or profit sharing, quote, profit sharing portion of it for multiple plans into a maximal amount. So, and if that's kind of a lot of information and maybe a little bit outside the scope of what you really asked, but I think it kind of illustrates some good points about deductibility and participation on multiple plans, because yes, you can certainly be covered by multiple different types of retirement plans, but there are going to be some factors that are definitely going to contribute into what types of deductions you might be able to take or not take depending on the type of plan you're looking at. So what do these contribution comparisons look like? Let's take a look at it. So for 2022, John is a sole proprietor making 100 grand. So with a simple IRA, he can contribute $14,000 of salary deferral plus a $3,000 employer match, 17 grand, pretty easy. SEP IRA, he gets to take 25% of that $100,000. He gets to write off 25 grand and plug that into a SEP IRA. Solo 401k, again, a little bit more of a complicated thing to look at, but you get a significantly higher amount of contribution limit for the same amount of compensation being paid. So with a solo 401k, actually, I didn't update that number correctly. It's $1,000 off. So he's under the age of 50. He can contribute up to $20,500 plus $25,000 of employer match. So really, he can contribute up to $45,500 into that plan. I know this just had last year's deferral of compensation on it. But $20,500 for the salary deferral plus the $25,000 employer match. Remember, 25% of the income going into that, with a total of $45,500. You get a lot more in there for the exact same amount of money being paid. So depending on how much you want to do or what type of flexibility you want, the 401k is very powerful in that aspect. Catch-up contributions, if you're over the age of 50, the simple IRA is $3,000. The SEP IRA, there's no catch-up, and a solo 401k is an additional $6,500 of salary deferral. Now, with IRAs, you really only have one option for administration. They are custodially driven accounts. You don't have the option to kind of self-administer it to the point of it just being set up like that. Yes, you can set up things like checkbook control where you have a separate LLC that the plan's funneled into that your name is the manager of. Yes, you can do that kind of thing, but it is an additional step of layering and complexity that you have to take into consideration with that. Now, with a solo 401k, you have a lot of options on the front end. You can say, hey, I would like to self-administer this, or I would like to have some record keeping, or I would like to have full service plan record keeping and reporting on the onset from this, because you get to act as the plan trustee. So how much control do you want? So cash and assets can be administered by Advanta, for John in this case, or John is the trustee of his plan. He can do his own plan, where essentially he just has rented our plan documents, opens up a cash account, does all of his own record keeping, and doesn't need to call us for anything. Patch just maybe the occasional question, but we do no cash record keeping. He does all the plan reporting. He gets to write checks directly out of the trust account for the 401k. Very straightforward way to get checkbook control. But again, he's taking on a lot of the responsibility of all the plan administration. With that said, the nice thing about doing something like this is that it's very cheap to do like that. Depending on a lot of other factors, I won't get too far into what our fees are for everything else, because that's going to be determined a lot on what you're doing. But to do your own 401k plan with us is $300 per year. That's it. You get to have all the power of 401k and administer the whole thing for $300 a year. It is an absolute fantastic deal, but you are taking on a lot of responsibility. You have to understand that. It's not just something that is going to be, as maybe straightforward as doing a SEP IRA where everything's administered by us. You have to understand and be able to take on that responsibility of record keeping if you want to do your own plan. So with that said, you don't have to do any type of complicated, or I guess the amount of complication with doing a checkbook control structure is mainly based on who's doing it. So it may be complicated to some, may not be to others. But it's important to understand that the 401k offers you the option to do checkbook control inherently in the way that it's structured, unlike any other plan out there. So IRAs, SEP IRAs, simple IRAs, ESAs, HSAs, none of them offer that type of flexibility, which is, again, one thing that I really enjoy about the solo 401k is that degree of flexibility for clients using that plan. Now, considerations of leverage. One of the really cool things that I mentioned earlier is that 401ks have no obligation to pay unrelated debt finance income tax, or UDFI, if they finance the purchase of a new piece of real estate. So all employer plans can use leverage. However, SEP IRAs and simple IRAs, if they use leverage, are going to have to pay unrelated debt finance income tax and also file an additional tax return for the IRA itself. And the IRA is going to have to potentially pay taxes, which is kind of defeating the purpose of having the tax shelter in the first place. So a lot of people don't do that. If you want to use debt financing, especially for buying real estate, solo 401ks are the way to go. All financing has to be non-recourse in these scenarios, meaning that you're not levying any personal guarantee to it. Has to be fully non-recourse. There is no way around that. You can't pledge other personal assets as collateral. You can't use any type of your personal credit worthiness in order to secure that loan. It has to just be based solely on the deal and no recourse given. We can certainly help you out with finding people that do these types of loans, but important to understand because that is a big, big deal. Different plans can use leverage with different considerations. Again, the solo 401k being able to be exempted from the tax payment requirement in that additional tax filing. So the way that it works is the amount of income derived from the leverage portion of the asset will be taxed. So easy math, you buy a property that's worth $200,000 with $100,000 down and $100,000 financed. The amount of income based on the average underlying equity in the average underlying debt in the property over 12 months is going to be what you're going to have to calculate your taxable liability on. It's taxed at trust rates, and you have to file 990T. You do get to take advantage of tax write-offs and depreciation and expenses when you do this, but again, that's a whole other thing that you have to do. With a 401k account, you're just specifically exempted from it. You don't have to worry about any of that kind of stuff. It makes your life a lot easier. Let's see if we've got a question. If I am simply using the solo 401k in the form of a promissory note that accrues interest once a year, is there still a lot of work on my end in terms of administration of the 401k? No, not really. I mean, if you just use the 401k and make a loan out of it, it's pretty straightforward. You just need to make sure that you have loan documents prepared in the name of the IRA, or sorry, the name of the 401k, that everything's properly documented and funded. But I mean, after it's funded, it basically just gets income comes in, and that's really the end of it. It's really, I'd say loans are probably one of the easier things to go about using with these types of. Again, asked, can you explain a trader business underneath the 401k? Yeah, so an active trader business. So if you use an IRA to invest in something that generates active earned income, so let's say you bought membership in an LLC, essentially a non-passive position. So let's say you bought membership of an LLC that owns coin laundries or something like that. That's an active trader business that you own. So you'd have to pay UBIT no matter what type of plan it is. If you are invested, if you try to invest your plan into, let's say, the general partnership stake in a large syndication, that'd be an active trader position because it's not paid out as passive income. There's actually active earned income that is generated with a general partnership stake. So things like that. But you can utilize C Corps as blockers to that types of things. But again, if you are invested into something, shares of a C Corp, then you might have, you might be getting losses associated with the additional corporate income tax that you might have to pay the corporate side of things. So there's ways around the trader business UBIT stuff, but they're not always necessarily very palatable. But in general, that's what an active trader business looks like. Now, how do you actually define it? Is there a testing method for it? Fortunately not. So you can make the argument that someone is engaging in an active trader business of buying and selling real estate, but at what point does the buying and selling of real estate become an active trader business? Well, tough to say. If you buy 5 pieces of property and sell them in a year, is that an active trader business? Probably not. If you do 30, possibly. So it depends on a lot of factors, and there unfortunately is a bit of a gray area with that. The IRS doesn't clearly define it, so it's again a little bit hard to say. The 401k invests in an LLC as a passive investor, does it apply? Well, it depends on how the LLC is essentially distributing income and what type of activity that they're based in. Again, if that LLC is operating a coin laundry and you're a member, well, just because you're not going out and taking the coins out of it doesn't mean you don't have a stake in an active trader business. If you want to invest in something that, maybe look at structuring it like a note to the trader business instead of an equity stake. That's one way to kind of structure things around that. Land investment, I mean, if it's one, probably not. But with that said, that's kind of the end of what I got. I'll stick around for some questions. This will be recorded and up on YouTube for anyone to consume at a later date. Again, the handouts are attached as well. If you have any questions, I am always happy to answer those. I do apologize for a little bit of issues we had on the front end with the audio. Hopefully it came through well enough. I have to love just awesome internet service providers providing great internet. But with that said, that's pretty much it. Like I said, stick around for questions. I'd love to answer anything that people have. If you have a specific deal or want me to take a look at something, now is your chance to ask. So please do ask away. Someone asked, what are the advantages, disadvantages of solo 401k versus Roth 401k? Well, I mean, from a purely top level view, the advantages from the investment, I should say, let's break this down a little bit. So from a perspective of investment options, zero difference. You can do the exact same type of investments with a Roth 401k versus a Roth a Roth 401k versus a traditional tax deferred one. Your investment options and contribution limits and everything are exactly the same. really the benefit, advantage, disadvantage comes into how much of a tax deduction do you need presently? Do you not need any? Then do it as a Roth 401k. Don't take any tax deductions for what you're putting in there, and then don't have to pay any taxes on the way out. If you're someone that's getting hammered with taxes, then yeah, you really probably want to look at making everything deductible so that way you get to reduce the amount of taxes you have, still get the great tax sheltered nature of the 401k and the additional benefit of investing with the additional benefit of the tax write-off. So I would say that's probably where I would draw the line on looking at the advantage versus disadvantage of them. You know, the tax benefit's the same really in the investing side of things. You buy something, sell it for a profit. That profit is not taxed whether it's a traditional or Roth 401k. It just has to do with the tax deduction on the front end and whether you pay taxes on the back end or not. Let's see. I have a small business consulting at 25K a year. And I want to consider a 401k self-directed. 7 years old, don't need the income. Can I also use a Roth 401k? Yeah, well, you can definitely do that. You know, you can certainly utilize that to defer almost all of that income into the plan. That's, again, one of the nice things about that is with your age, you can contribute less your self-employment tax almost the entirety of the compensation that you had per year and create a nice little tax write-off if you don't need that money. Let's see, another question. I want to diversify my portfolio between traditional and Roth solo 401k. Do I have to create 2 accounts with Advanta? Fantastic question. So that really kind of depends on your penchant for record keeping. So you as the trustee can basically do an omnibus account where you have commingled pre and post tax contributions in there. But what you're going to have to do is you're going to have to track the underlying, you're going to have to track the net earnings attributable to both your pre and post tax basis in the account for the perpetuity that you have them commingled in an omnibus account. So that's a real fancy way of saying, yeah, you can commingle them, but you're going to have a lot of record keeping to do on your end. With that said, you can certainly have 2 different cash accounts with us and separate everything out. It's going to be additional record keeping on our side. It's a little bit more expensive, but what's the time value of money when it comes to all the additional record keeping and calculations you'd have to do on your end to make sure that you keep everything straight so you're not getting double taxed on anything, and also being compliant when you're claiming that you don't owe taxes versus that. So you can commingle them if you want to, but I would say a lot of people elect not to because a lot of people don't want to do that much record keeping. Let's see, another question. I have a 401k and a profit sharing plan. Can I set up an Advanta IRA solo 401k? Well, that depends. Is this profit sharing plan based on the same business activity you want to attach the 401k to? Or do you have self-employed income that you would like to use the solo 401k in order to defer outside the profit sharing plan? Maybe you participated in a larger business. That's really kind of the question that needs to be answered. So can you be covered by 2 different plans? Absolutely. Let's see, is there a requirement to file a tax return once funds in a solo 401k reach a certain limit? Kind of. It's not necessarily a tax return. It's a plan report called 5500 EZ. And once the plan has assets that reach or exceed $250,000, you are required to file that. With that said, it is a very easy report to do. It's about 2 pages, and unlike most IRS tax forms, 5500 EZ is easy. Couldn't resist making that joke, but yeah, it's not that bad. But you don't have to do it until you get to $250,000 of plan assets. So, you know, unless you're rolling over a sizable chunk, then typically people don't have to do that report for a couple years, which is nice. All right. Don't see any other questions coming in. Again, if anyone has any questions or they'd like to schedule a consultation, all of my direct contact information is right up there on there. If you want the slides, they are attached as a handout. With that said, I want to thank each and every one of you for tuning into these. We greatly appreciate your attendance, and your attendance is what continues to drive us to put these on every few days. So again, if there's any other questions, feel free to reach out to me or anyone else on my team. We are always happy to help. With that said, have a wonderful Thursday, and I hope to see you on the next webinar.